On Business and Corporate Saturday. South Africa signs off wind project bidders to help reduce power costs. Egypt's central bank MPC meets today on interest rates amid high inflation. And Kenya's new car sales fall to 8-month low in August. Good afternoon. Good to have you once again. This is Business Incorporated on Channels Television. I'm Amy John Mekwa. Let's begin as usual with market numbers in Africa. For intraday, we see that the NGX is still down by 0.02%, continuing that bearish trend that we've had for a couple of days now. Just one day relief we've had this week. And it's at 49,411.89 points at intraday. South Africa is also down, still like yesterday, at 65,000, more than 65,000. In the other parts of the continent, we have Egypt still in the red, 0.03, at least that is mild, 9,953.28 points. And Kenya closed yesterday negative 0.16% at 134.75%. From Africa, we move to the Middle East. It's also negative sentiments across major markets that we track in that region. Abu Dhabi is down almost half a percentage, 0.41%, and that's at 10,093.97. Dubai is also down more than 1% at 3,460.52. Looking at other parts of that region now, we see Qatar is also down. It's a red market, red market everywhere, more than 1%. Saudi is also down 0.37%. That's 11,461.09. Let's head to Europe now, find out what's going on there. The EU is planning a new round of sanctions against Russia following President Vladimir Putin's latest escalation in his war against Ukraine. The 27 member states will likely seek consensus on any package before their next formal meeting, which will be in mid-October. Do we have an idea of what the sanctions may look like this time around? We have Stephen Bersley now joining us from Berlin. Hi, Stephen. Good afternoon. Well, we do know that this is an ongoing war, but why the call for sanctions at this time?
Well, the EU and EU member states have been roundly critical of the remarks made by Russian President Vladimir Putin yesterday, in which he called for a partial mobilization and also threatened the use of nuclear weapons as part of this conflict. EU Foreign Affairs Chief Josep Borrell joining other critics in saying that that was a definite escalation. Borrell and EU member states have also been critical of the so-called referendums that Moscow is planning for Ukrainian territories later this week, calling it a sham. That is actually one of the main drivers, frankly, of these sanctions. Even before Putin's remarks yesterday, there was a feeling that if these referendums were to go forward, that there was going to be a clear response by the West. So we see that really that's going to be driving this as much as Putin's remarks about the mobilization.
So it seems like everyone and everything has been targeted by sanctions. What else will be sanctioned?
Yeah, this would be the 7th package of sanctions. Borrell was not specific on exactly what would be targeted, but he did say that, like other packages that have been passed to this point or that have been agreed upon to this point, that it will target a mixture of individuals as well as sectors of the Russian economy. What we can imagine is that since the referendums are one of the driving aspects for these sanctions or behind these sanctions, that it could be individuals who are related to the organization of those so-called referendums in Ukrainian territory would be targeted under any kind of sanctions package. Also worth mentioning that there are things that will not be included. Food and fertilizer, for example. Borrell has made that clear, given the critical need for both of those commodities to be exported out of Russia and out of Ukraine in the coming months to help other parts of the world. And we know that certain energy aspects are being handled in other discussions. For example, right now, the discussion over capping oil prices is happening outside of this larger discussion on a new sanctions package. And then, of course, we should note that whatever the EU is going to do, it's almost certainly to be joined by members of the G7 group of leading economies, which would bring in the US, UK, and Japan.
All right, so let's move away from that and see how the markets are doing.
Right. Hungary is the mostly unspoken concern when it comes to new sanctions or new measures against Russia. They've voiced a certain kind of fatigue or concern with past sanctions packages, although for the most part they have gone alongside with them, with the exception of the oil embargo that's to be put in place later this year by European Union member states. Hungary got an exemption in that case because of its dependence on pipeline deliveries from Russia, and so it may try and drag its feet again. Remember, though, that there is a large push amongst the rest of the EU for this, and so in one sense, Hungary is outweighed by other nations that are insistent that something needs to happen, even if it can't necessarily be outvoted. There has to be consensus here. So this is a very typical scenario in recent months, is that EU member states have to jockey a bit with Hungary, see how far they can come. And also, let's keep in mind that the EU as a whole and as a bloc, but also as member states, has a great deal of leverage over Hungary because of those economic ties. So we can't rule anything out, but it's definitely a concern, and it will. It's very likely that it could show its face again.
All right, Stephen, thank you so much for that update. So we'll certainly be following up to see the new sanctions. Now let's go over to London, where Juliana is always standing by to give us updates from there. And this morning we talked about expectations as the Bank of England meets, and now we see that there was a split, 5-3-1 over rate hike. One would have thought that it would be a straight, unanimous agreements on rate hike, especially when we've talked so much about inflation and all of that, Juliana.
You're absolutely right, Innie. Good afternoon. Well, I think economists weren't surprised that there was such a split because the UK economic outlook is just so gloomy at the moment. I think the MPC members just want to make sure that they are getting it right. As you said, a three-way split. We had 5 MPC members voting for what we got, which was a 0.5% hike. That included the governor, Andrew Bailey. 3 governors voted for a 0.75%, a much more hawkish stance following what we saw from the Fed Reserve last night in America. And then the newest MPC member, Swati Gindra, she voted for a 0.25% rate, clearly concerned about the economic fallout. And there will be economic fallout either way, because of course there are about 4 million homeowners in the UK that are not on fixed rate mortgages, and on top of all of the other bills that they're having to contend with, they are going to be seeing a surge in mortgage payments. So that is a huge issue. But of course the big story of the day, that 0.5% rise, this is to combat high inflation in the UK. It did dip slightly in August from 10.1% in July to 9.9%, but still way higher than the 2% benchmark, which is what the Bank of England are feeling they will have to adjust, because these high inflation rates could be with us for some time. I think one of the reasons why, and according to the memo that was released by Andrew Bailey, for them not going as hawkish as what we saw in America, is because of this new UK energy price plan. Now, a couple of weeks ago, before the Queen's death, Liz Truss did announce that there would be a freeze on energy prices. There were concerns that for some people it could go up as high as £6,000 a year because of the war in Ukraine. But she has decided to freeze that to £2,500 max per year per household for 2 years, and that will slowly bring down inflation. Again, one of the other reasons why the Bank of England decided to lower their forecast of inflation from 13% at a peak, which it said we could get to about 11%. So pretty interesting overall. This obviously comes on the eve of tomorrow's mini budget, a hotly anticipated budget. Yes, we've got this freeze on energy bills, but there are so many other issues that are going on within the UK economy. And of course, we discussed early this morning, Innie, the Institute for Fiscal Studies, which said that public sector net borrowing, which stood at 11.8 billion in August, just cannot continue, because of course you can pile on the debt, but the taxpayer will ultimately have to pay. So is austerity coming, closer than we speak? According to the IFS, yes, if we go along with Liz Truss's tax your way out of recession. So we just have to wait and see. But 0.5%, much less than the market expected, but the 7th consecutive rise nonetheless.
Yeah, so how's the market reacting to that 0.5%?
Well, not great. The FTSE All-Share slightly up, 0.51%, but the FTSE 100, that's down by 0.31%. And the FTSE 250, the domestic market, that's down by triple-digit figures, 1.24%. That's the local companies in the UK. In the currencies market, the British pound is slightly up against the US dollar by 0.48%, though it did lose some of its gains that it had this morning. The British pound is currently up against the euro by 0.12%, but down against the Japanese yen at intraday by 0.48% in E.
All right, Juliana, thank you so much. And we're looking forward to that mini budget tomorrow. It's going to make a great conversation. Looking forward to that.
Yeah.
All right, so let's go to other markets now. Asia market, it's traded low on Thursday after the U.S. Federal Reserve raised interest rates and signaled further hikes ahead of U.S. stocks. So we're volatile and closed sharply lower following the announcement. Looking at the numbers here, we see the Nikkei 225 in the red again. So much red as the dollar gains strength. We see all of this. The Nikkei 225 down 0.58% at 27,153.83. The Shanghai Composite it's also down 0.27%, less than that, 3,108.91. And then the Hang Seng Index is also down more than 1.5% at intraday, 18,147.95. In the United States, stock futures were slightly lower also, following a big decline in the major averages as traders weighed another large rate hike from the Federal Reserve. Dow Jones Industrial Average fell, recovered later on at 0.02%. S&P features down 0.09%. Nasdaq features also down. And remember, the Federal Reserve has said that this hawkish stance in dealing with inflation is going to be consistent until the target is hit, and we don't know when that will be, because obviously the parameters are still there: energy costs and food costs. Oil prices rebounded after sliding by 1% in the previous session as concerns over tight supplies heading into winter eclipsed fears of a global recession. Brent crude futures rose by 0.6% to $90.33 a barrel, recouping their losses in early Asia trade, while U.S. West Texas Intermediate crude rose 45 cents to $83.39 a barrel. Both benchmarks fell to a near two-week low on Wednesday after the U.S. Federal Reserve raised interest rates by 75 basis points for the third time to tame inflation and signaled that borrowing costs will keep rising this year. Meanwhile, some Chinese refineries are considering increasing runs in October, eyeing stronger demand and a potential reversal of Beijing's fuel export policy, which could boost crude oil demand. Metals market now. Gold prices fell by 1% as the United States dollar rallied and the Federal Reserve flagged more large rate hikes, diminishing the zero-yielding metals appeal. Spot gold was down by 0.8% at $1,660.55 per ounce, and U.S. gold futures was also down 0.4% at $1,668.20. Analysts say the hawkish federal projections are a rather grim outlook for the economy and could eventually trigger a resumption of safe haven role for gold. In other metals, spot silver shed 1.2% to $19.36 per ounce. Platinum slipped 0.6% to $902.02, while palladium fell 0.4% to $2,145.60 per ounce. Let's take a break now. When we come back, we do have a conversation for you on the commodity space as well as other stories from Africa. This is Business Incorporated on Channels Television. You're welcome back to watching Business Incorporated here on Channels Television. August data released by the National Bureau of Statistics recorded a slight deceleration in the monthly food basket by 1.98%, and that's because this is harvest season, so it's not really something to celebrate. However, yam prices, in spite of this, increased from initial 800 naira per tuber to 2,200 in Lagos State. I can tell you it goes for more than that in this area. 1,700 in Ogun State, 1,500 in Oyo State, and Benue farmers have blamed this problem on banditry and insecurity. Let's dig deep into this yam issue with Chinazo Ewezo, analyst with Financial Derivatives Company. Hi, Chinazo. Good afternoon. Thank you so much for your time this afternoon. So this surge in the price of yam, has it affected the consumption or demand of local dishes? We do know that insecurity has been with us for, unfortunately, some time now, and we've talked a whole lot about that. But are people switching from yam dishes or yam-based dishes to alternatives?
So the yam shortage is as a result of the insecurity caused by banditry, herdsmen invading farms in Benue. So this is as a result of this has caused shortages in the yam market and has led to an increase in the price of yam because there is less supply and high demand. So the fact that there is high demand for yam doesn't necessarily mean that people would switch to other alternatives. But because of yam is a very important food in Nigeria, they might keep buying, but at a very high price. So the consumers are clamoring because of the high price, but they cannot just switch to other alternatives because of the importance of yam, but they will have to keep buying at the same price, but it's higher than the previous prices.
Okay, so even the yam traders, the mill companies that make flours and do other things, they still have to stick to yam. I guess the bottom line would be that they will increase the prices of their commodities.
Yes, that would be the consequence because they also have to keep on buying the yam to supply consumers with what they need, which means they will have to transfer the burden from their own end to the consumers in form of high prices.
And then the FAO, the Food and Agriculture Organization, had said that Nigeria recorded a decline in yam exports, and they based it on government policies. Tell us more about this and what could be done about it.
Nigeria has necessary export policies to promote exports of goods and services, but the problem is its efficiency. It's not as efficient as it should be. But okay, Nigeria is the highest and largest producer of yam, but it's not the highest exporter of yam. Ghana is in fact the highest exporter of yam. Why is this? Because Ghana has better branding and better packaging, as well as better storage facilities to lengthen the yam lifespan. But Nigeria doesn't have as much storage facilities as it should have, and doesn't have better branding and packaging to attract consumers to invest in the market and attract buyers to buy from us. So to make this better, Nigeria should invest in agricultural sector to provide better storage facilities, to provide farmers with necessary equipment to increase production, to also facilitate loans for local farmers to enhance productivity, agricultural effectiveness. So there are policies, but they are not as effective as it should be. So doing all this should make the policies effective and increase yam production and exports.
All right, Chinazo, and it looks like we do have some lessons to learn from Ghana. Thank you so much, Chinazo Ewezo, analyst with Financial Derivatives Company. All right, moving on now. South Africa's Department of Mineral Resources and Energy has signed off 3 onshore wind stations from a delayed round of bidding to provide renewable power, an initiative intended to help mitigate record levels of power cuts. The Colescop Wind Power, Sankral Wind Power, and the Zukomaya Wind Power development are the first 3 preferred bidders to be signed off. A total of 25 wind and solar power projects worth about 50 billion rand of investment and forecast to add nearly 2,600 megawatts to the national grid were announced almost a year ago. South Africa suffered a record year for power cuts, with state-owned Eskom unable to meet demand as a fleet of aging coal stations experienced frequent breakdowns. The country is currently on stage 5 load shedding, with areas going up to 6 hours per day without power. We move to Ghana, where the country has signed up for a continental initiative aimed at providing cheaper power for its citizens through the new Regional Liquidity Support Facility, RLSF. The country recently signed a memorandum of understanding with Nairobi-based African Trade Insurance Agency, ATI, for the rollout of the facility, in line with its mission to promote access to reliable, clean, and affordable electricity. According to ATI, the MOU comes at a time when the demand for energy in Ghana is increasing by 10% annually. Data shows Ghana has one of Africa's highest rates of access to power at 86.63%, with 74% of rural residents and 95% of urban residents connected to the electricity grid. With a total installed capacity of over 5,300 megawatts, Ghana also exports excess power to its neighbors, which include Benin, Burkina Faso, and Togo. The country is the 9th ATI member state to sign the MOU, joining Benin, Burundi, Cote d'Ivoire, Madagascar, Malawi, Togo, Uganda, and Zambia. And Kenya's car sales in the year to August fell 38.6%, recording the lowest 8-month sales in the last 15 years. Latest numbers from Kenya Motor Industry Association show that a total of 8,752 units were sold between January and August, a fall from 14,250 units sold in the same period last year. The drop came with a noticeable reduction on sales last month when the country went into an election period, with the industry selling only 954 units, and that was down from 1,235 vehicles which were sold in July. During the period, exports of new units increased slightly by about 6.7% to 206 units, with Tanzania and Uganda as the key markets. During the period, Isuzu East Africa continued to dominate the market with a 43.4% market share, having sold 3,799 units, followed by Toyota with more than 2,000 units and 23.2% share of the markets. Egypt's central bank is plotting out its next move on interest rates to get a grip on inflation, which has put further pressure on its currency. The fastest increases in consumer prices since 2018 mean that monetary tightening is likely to resume this week. But the market is also on the lookout for more guidance from policymakers, with the currency still weakening and in the spotlight after its devaluation earlier this year. Though economists are divided over what the central bank will do at the rates meeting today, a survey shows that most expect a hike of 50 to 100 basis points. The Monetary Policy Committee has kept the benchmark deposits rate at 11.25% for 2 meetings. And still in Egypt, the Financial Regulatory Authority, FRA, has approved the launch of a new investment fund for financial investments to invest in Egyptian and foreign currencies listed on the Egyptian exchange, particularly in shares. Named NE Capital, with a cumulative periodic return on the equity fund, the newly established fund is an open investment fund with the documents offered through public subscription. Apart from investing in securities on the EGX, the fund will also invest in short and medium-term fixed return instruments, including debt instruments whose credit rating is not less than FRA's minimum limit acceptable or its equivalent. Following the approval of the issuance of the fund's documents, the license obtained from the FRA will enable In Capital to use a total issuance of funds reaching 139 investment funds with a total value of approximately 107.6 billion Egyptian pounds, including 14 funds this year. From Egypt, we'll go to Zimbabwe, where the finance minister has warned that persistent inflation will force the government to pursue an aggressive path to further tighten monetary and fiscal policies to cool down an already overheated economy. This comes as he projects the country's annual inflation to hit two-digit levels next year. The Treasury chief believes further tightening of the monetary and fiscal policies will slow down the increasingly evident inflation momentum and promote economic stability in the short to long term. In addition to tightening monetary stance, the Reserve Bank of Zimbabwe increased interest rates to 200% from 80%, and all to curb speculative borrowing. Zimbabwe's inflation went down to about 60.7% in January this year. However, it's now up to 285% as at August. The country is currently experiencing the sharpest and most prolonged resurgence of inflation since July 2020, when it peaked at 837%. And finally on the program, the gap between the Ethiopian currency's official and parallel market exchange rate widened to a record as foreign reserves dwindled and fighting in the country's north resumed. The country's currency, the birr, traded as high as $92 a dollar on the black market, while the official rate remained 52.5. The vice governor and chief economist of the country's central bank attributes the widening gap of the exchange rate mainly to heightened risk surrounding the ongoing conflict in the country. In June, the IMF predicted economic growth in the East African country may slow to 3.8% in 2021-2022 because of the conflict, lower agricultural production, a fall in donor financing, and intensifying foreign exchange shortages, as well as drought and spillovers from the war which is still ongoing in Ukraine. That's the program for today. Thank you so much for being a part of it. Let's do it again tomorrow, starting with 10 a.m., Business Morning, and of course 1:30, there'll be Business Incorporated. I'm Ini John Mekwa. Enjoy the rest of your day.